How often do people actually reach out to you and send you their portfolios looking for your feedback?
Nonstop. Now, I would say that not always the full portfolio, but financial questions, snapshots of parts of their financial lives, if not their whole financial lives, literally every day, many times. Every day, many times, never stops.
Wow.
And all the questions they keep coming in. And for a long time, we got back to 100% of people. Now I would say we get back to 80 something percent of people. But even the ones we don't get back to, we get back to, but we get back to you to say, sorry, can't take a look at it. I don't look at the portfolios as closely as I once did. And I didn't do that to give specific advice. I don't think that would have been appropriate. I did it more for my own learning, but I do look at a lot of the financial planning questions. And one of the things you can see is where people are getting bad advice or whether they're doing something on their own and they're getting off the rails. But yeah, what a great learning experience. And lately, it's been incredibly helpful to me to see so many spending summaries where people have chronicled where every nickel and dime is going, and then they send it in and say, hey, take a look at this. And I love it. Like I don't care if I sound like a complete loser and social geek. I love sitting in and looking at people's spending summaries. And they're all a little bit different. Yes, there's a tremendous number of common denominators, and we're all spending on food, shelter, et cetera. But how much weighting we put in the different areas and how we spend it and where we go wrong, where we overspend, it's fascinating to see. And it's really helped me again putting together the revised version of the book.
I think you mentioned to me at one point that you used to do some pretty detailed analysis of people's portfolios when they would send them in. What were your observations on individual investor returns from that experience?
Well, Ben, it's funny because you're one of my heroes in this industry, and I mean that. Like I love following your stuff and how in depth you go. But you and I are very much alike. I ended up teaching more or less the basics and wrapping them in stories and wrapping them in humor. But the real Dave Chilton is a math geek to the nth degree and a guy who studies all of this stuff too much so. Like I'm almost as weird as you are. I don't think as weird, the way you could quote all the studies, et cetera. But I'm right there. So when I started getting all these portfolios, I loved looking at them, not so much how they were constructed, but the performance and just checking it all out. The problem is you have to be very careful on a couple fronts. Number one, you can't just take everybody who sends it because remember, a fair number of people are sending you the portfolio because they're doing poorly. So they're self-selecting
Yeah.
based on bad performance, and therefore you have to be very careful what conclusions you draw. You almost have to just look at the portfolios when you're studying them of the people who are sending you questions for other reasons, and then also showed you their portfolio. Then the second thing is when you're trying to calculate their returns, it's tricky because remember, unlike an example in a book, money's coming in, money's going out. Sometimes money is heavily weighted in the US market, sometimes more so in Canada. Sometimes people go to cash for a while, then they go back in. You have to have all that data to make the proper calculations. So you may have hundreds and hundreds and hundreds of people sending you through the portfolios, but not comprehensive data that allows you to do the proper analysis. But I got enough of them. In fact, at one point, I shared this with Rob Carrick back in 2010-ish. I had 51 where I had comprehensive data, strange number, but 51 exactly, and looked through them all. I used the old Vesttrack software from the two math guys from Kitchener-Waterloo, coincidentally, and then I had University of Waterloo people check it through. And I have a better example in a minute, but 0 for 51 in terms of keeping up with the markets. That wouldn't you
Wow.
think somebody would have lucked into it? That they would have had a concentrated portfolio and one or two of the stocks would have carried 0 for 51 over
Wow.
10 and 15-year periods. It was quite remarkable. But the biggest thing that jumped at me was the underperformance on average was significantly bigger, even when they were in mutual funds, than the mutual fund expense ratios. So instead of being 2 to 2.25%, it was 3.75 to 4% quite often. And of course, as you three know, it's because people were buying in when markets were high, often getting out when markets were low. But beyond that, even when they weren't doing that, they tended to be quite adept at picking the funds that were about to underperform. So we may not be able to pick the future outperformers, but we seem to be quite good at picking the future underperformers. And I think it's basically because a lot of times we buy the funds that have been hot over the last year, two, and three. They've been overweighted in the hot sectors, and regression to the means bites the people as soon as they get in and leads to some subperformance. So the basic summary of the data was it was depressing. Not far off, by the way, a lot of what you see from Delbar. I think a lot of my numbers were very similar to what their conclusions have been over the years. The other one was years earlier. We had over 100 where we did a lot of the same types of things. Now, out of fairness, I think 7 or 8 people in that group did in fact outperform over extended time frames. A little bit of it was interesting. Some of them were accidental outperformers where they had bought into very conservative portfolios, say Canadian banks, but they had one or two of the right ones during an early part of the declining interest rate environment, and they've been able to outperform accidentally. But you know what I've never crossed paths with is traders who outperform. So all of these, I never see people moving in and out and outperforming the broad market averages. I have seen a couple interesting outperformers who do it consistently well. They're doing it almost full time. They have backgrounds in finance and they're focused, you'll find this fascinating, on Canadian small and mid cap stocks. They're underfollowed, they're underowned by institutions. They think they can get an edge just by getting to know management teams, studying the industries, and sure enough, over very extended time frames, they put up significant outperformance numbers. But remember, 99% of your listeners, and you have a sophisticated audience, can't duplicate that success. They don't have the time and the expertise and the contacts to follow up in doing it. The bottom line is if you add those two studies together, and I call them studies because I took them very seriously, and you're at 150-ish something portfolios over 10, 15, and 20-year periods, and you see 8 to 9 total outperforming, and not dramatically so, but outperforming, maybe two dramatics, it tells you the kinds of odds people are up against. It is tough to beat the broad market averages purchased through a low-cost ETF. Beyond tough.
Yeah, wild. Your point about people buying funds that tend to underperform. There is a 2018 paper from Rob Arnott on that. It's I think it's like the folly of hiring winners and firing losers or something like that. But they basically show that funds that have performed well recently tend to own securities that have high valuations, which explains partially why they've performed well. People buy into those funds and end up underperforming. So it's exactly kind of what you observed in those studies.
Yeah, and I think lately we may have had a few exceptions to that in the last 10 years because some of the high price stocks just kept getting higher and higher and higher price stock valuations because of momentum, because of passive investing, and because some of their models were very good and we underestimated the power of, say, the network effect. But in general, I think that observation will always hold. And boy, I wish we could find the future outperformers. I would love to be a guy who could figure all that out and share that information with people, but I'm not him, and I would argue that person's not out there.
So, Dave, if somebody has a large pile of cash to invest, how do you think about and communicate that decision between lump sum now or dollar cost average over a certain number of months or years?
You know, it's such an interesting question because it's something we're seeing way more of now. Like this question's very relevant. I'm sure in your practice, you're seeing much more of it than you did 10 and 15 years ago because we've got inheritances coming into play because of demographics and because we have more wealthy people, but also you have a lot of business sales now by the baby boomers. And those two things are causing this question to be asked much more often. And I think in general, when you study it carefully and you look at the long-term performance of the various asset classes, it's pretty tough to argue the math of saying, hey, go into equities full bore if that's what you're trying to do. So I'm saying, assuming you're going to have a significant equity component, get into it right away. That you're not going to be able to outguess the market, and because it's such a strongly performing asset class relative to cash, relative to what else you'd have to be into, the odds favor maybe even 2 to 1, 2.5 to 1, that being the best of the strategies. But psychology does play a role here. And a lot of times you're dealing with people, let's say the person who sold a business, who's not been involved in the markets very much. All of their wealth that's been tied up in the business. To suddenly take all of that and put it in the markets is dangerous because if the markets do have a pullback, I would argue that person may be a little bit more inclined to panic and think, I just got all this money. It took me 30, 40, 50 years. It took us 100 years as a family to build it up. I'm not sure I'm comfortable taking on that level of risk, even if the math says I should. What about easing it in? And then you can go the dollar cost averaging route. But I was saying recently, I think it was on a video, it may have been in a conversation, that some of my friends have kind of mixed the two. So they've gone in with 40 to 50%, and then they've dollar cost averaged whatever they were trying to get in equities over a 2 to 3 year period, the rest of it. Again, the price of markets probably makes a little bit of a difference, but Ben has spoken about that sounds great in theory, but in practice, none of us can tend to apply that particularly well. We can say, oh, the markets are expensive and therefore we're going to wait, but often they become more and more expensive and you wish you hadn't done that. So a lot of these things, again, sound like they're common sense, but they don't hold when you put them up to true studies. So I don't think there's one answer for anybody. I really don't. If a young person comes into a lot of money. Let's say we're seeing more grandparents leave money directly to grandkids now. So let's say one of the grandkids is lucky for it to be a lot of money. Then you can make a pretty strong argument. Let's go heavy into the equities quickly, because if there is volatility right out of the gate on the downside, you've got the luxury of being patient. You're less likely to panic, but you've got to know the client here. I think that's a big part of this, is getting to know the person and what their mental makeup is like before you give them the advice.
Yeah, I think that's a great point, Dave. I know that a lot of people sort of in theory think that easing into the market a little bit at a time is going to be easier than just making a lump sum investment. And I think there is some truth to that. But what I've seen many times, even when we've done this strategy with clients, is if you're going to dollar cost average, say once a month over a year, now you have what's
12 decisions.
One difficult decision becomes 12 difficult decisions, right? And even though, yes, you're supposed to automate it and you're just supposed to make those purchases, I can't tell you how many times I've had clients, call me in the third month saying, whoa, let's put a pause on those monthly contributions or monthly purchases because I'm nervous. So, I think you have to look at both sides of the psychology.
That's a great point. And, it goes back to something I said when Ben was on our podcast. My father, who pays no attention, like literally zero, to the equities he has it right. He never tries to outsmart anything. And over the long term, that's really served him very, very well. And I think you're 100% right there, Dan. When you start easing in, if the markets pull back, it's just human nature to think they're going to pull back even more. And you're going to pause, even though you're buying low at that point. So again, knowing the client and what they're likely to do to react to all of these things is a very important part of this. Although forecasting reactions to stressful market times is not easy. None of us really know how we're going to behave in those times until they actually happen. So that's a tricky one. I'll tell you the most interesting observation I'll give you about this lump sum dollar cost averaging. If markets are roaring along, they're fantastic. The four of us would naturally think markets are expensive. Maybe it's a time to dollar cost average. Now, Ben would say, yeah, but probably should do that. I agree. But that's not the way the average person thinks. If markets are roaring along, that's when they're most likely to say, let's throw it all in. And when markets are struggling, that's when they say, let's dollar cost average, instead of jumping in when the markets are low. Because again, we extrapolate from the short-term trend when emotions are involved, fear, and it tends to guide our decision processes. Oftentimes, we'll do the exact opposite of what we should do when fear gets involved.
Another one of the great dilemmas that investors face is this idea of, if you've got extra cash, should I invest more or should I use it to pay down debt? So I'm sure you've taken this question from many people. How do you help them work through that decision?
Yeah, I would say that might be the most common question that I take. I think, again, you're dealing with a different level of income and wealth. You don't take that question as often, but when I'm out in the public, that's the one I'm asked the most often. And I think it's a tricky one. I mean, let's go to the extremes. Obviously, if it's credit card debt and somebody's paying 21% on that debt, non-deductible interest, pay it off. I mean, that's a guaranteed 21% return after tax. Even the best of the long-term performance isn't going to come close to that. So that makes a lot of sense to me. And if on the other hand, it's 0% debt, your parents have lent you some money, they're not even charging you interest, then prepaying it, paying it earlier than you have to, makes very little sense when you can take that money and invest it in whatever else. So those extremes kind of show you have to be thinking about the potential returns versus the interest rate on the debt, obviously. And then what do you use for the potential returns? So if you look at historical returns and let's say the Standard & Poor's 500, you might say it's 9 or 10%. I would argue, though, that might be a little high because we've had a great run lately, number one, and markets you're buying in at a fairly expensive level. And so if you're thinking all that through, you might want to use 7.5. I'm just throwing out a figure. And then you start thinking, is that going to be higher than the debt interest rate? So if it's a relatively low rate of 4% on a mortgage, then I think, yeah, you might want to invest for long-term growth if you can put up with the volatility, et cetera. That makes a lot of sense to me. And by the way, that's how most of the people I meet who've handled their money well have done it. They haven't paid off the mortgage as early as you think. They have instead invested for long-term growth. And of course, the markets have been quite strong over the last 30 years and then been rewarded. If on the other hand, though, you're looking at a debt that's a car loan debt of 7 to 8%, that's a different matter. Then that's guaranteed 7 to 8% after tax. I would tend to pay off the debt before I invested for the long-term growth. And a lot of this, again, still comes back to knowing the client, knowing the person involved, and are they likely to stick with the plan and be able to put up with the volatility and everything else. So the answer is depends very much on the facts involved.
What role do you see for financial advisors in people's lives?
Well, I'm pretty strongly opinionated on this. I mean, I've said for years, if your financial advisor is saying that he or she is going to add value through investment selection and outperforming the broad market averages, run, because they're likely not only to not be able to do that, but to underperform significantly. You want the financial advisor to be trying to add value through financial planning, including estate planning, insurance needs analysis, trying to minimize your taxes to whatever extent possible, helping you to communicate effectively with your kids, making sure your risk tolerance level is matched up to your portfolio. It's those types of things, even being a psychologist and coaching you through all of this and making sure you're staying on the straight and narrow during the ups and downs that the market inevitably throws at you. So I think that's the role of a good financial planner. And if one, or a good financial advisor, pardon me, if they're doing that and doing it well, then often the fees that you see are very much justified. But in Canada, let's be honest, we see a lot of the fees embedded in the high mutual fund expense ratios, and a lot of the advice given is not very deep, or it's not there at all. In fact, I would argue probably the latter. They don't give advice very, very often. And so again, it's all over the map, but I think you're going to see more and more firms in Canada use the model that you're using. When I'm in the States, your model is the one I see all over the place, and have, by the way, for 20 years now. So most of the friends I know down there, and I'm not talking the ultra wealthy or even the super affluent, I'm talking high middle income and up, they tend to be going to firms like yours and getting the fiduciary responsibilities and everything else wrapped into all of this. And it's comprehensive planning at quite a reasonable fee. So I think you'll see more and more of that going forward. You're also seeing a huge growth in do-it-yourselfers. Now, some of this is people that are trading irresponsibly and gambling too much. Forget that segment. You're also seeing a growing group of people who are doing this well. They're going on YouTube, they're listening to Rational Reminder, they're reading the right books, and they're saying, I can do this, and I'm going to keep going along this line. Then maybe once every few years, I'll use a fee-only financial planner, and I'll write a check for a few $1,000s to make sure I'm on the right track, get more comprehensive advice from a true expert, and go that path. I think you're going to see more of that too. So I think a mix of what you're doing and that will become more and more popular over time.
Okay,
You know
let's
where
jump to,
people it stink in the financial advice business, but it's a little better than it was 2 years ago. It's retirement income planning. So again, firms like yours that are using software and are involved with, clients who are quite well to do, you're doing that and have done it for years. But in general, even some of the high end advice we see in the financial field in Canada and the States, that's been a big weakness. Now, some people argue, oh, it's because selfishly they don't want you deaccumulating. They don't want you. I'm not even sure that is it. Like a lot of times, it's just they never really became experts in that. They didn't gain access to the software. The last 2 years, though, positive change. The software has become more ubiquitously used, and I think you're seeing a better job. There's been so much pressure because of all these good YouTube videos that people are putting out on how people should be thinking, that a lot of clients are saying to their advisor, you weren't saying those things to me. You weren't asking me those questions. I'm learning this from YouTube. And it's forced the industry, I think, to pick up its game a little bit, which is a good thing.